Think about the AR's inventory. What do you want to know about them? How current are they? Quality, the quality of the ARs, okay, on the inventory. Eligibility. What makes something ineligible? Delinquents? Yeah. So the quality, what's the quality of the ARs? Okay, we just talked about the inventory. What is the inventory? Yeah, it's a lot easier to sell sheet metal, big pieces of metal, than it is like little cutout pieces. Okay, anything else you guys think about? General usability, right? Anything else? What's the value of the collateral to the customer, to the bank, and in a forced liquidation? And that's something to really think about, especially when you're talking about taking this collateral and really counting on it. Because it's different in all those scenarios. What's the quality of the balance sheet assets? It's the AR and inventory we talked about. What's the collateral pricing relationship? Right. If you have more collateral and stronger collateral, you've got less risk. You can probably reduce your price, or it changes your price, and you see that in your risk tiers. So as you're making decisions and you're competing and you've got price pressure, you may not have structure pressure. You know, that's ways to balance, and collateral is a really good way to do that. And a lot of people are afraid to ask for collateral. It's amazing how many times when you just ask, people are really willing to give it. Okay, what are your pricing considerations? Other than CDS just tells you what the price is. Debt service coverage, okay? What else? Sorry? Years in business? Secondary? Okay. Credit. Okay, right, credit. So basically, you guys are listing all sort of financial considerations. What else do we consider? Other relationship with the bank? FICO? Business type, length of time in business. There's a whole list of financial considerations. I think you got them all. Debt service coverage, secondary payment source, company and principals, tangible net worth, the leverage position. Those two are in conjunction with one another. And the quality of the assets, liquidity of the borrower. What kind of secondary do you have? If he's got a little problem, can he help get you out? Other considerations are the credit history of the borrowers and the principals. Is this deal unsecured or secured? So back to the collateral issue. How long have they been in business? This guy's done great, and he's been in business 2 years. Same guy, he's been in business 20 years. Your risk is totally different. Other considerations are Wells Fargo's relationship, the bank's cost of funds. Which kind of product is it? What's it going to cost us? Therefore, should you price it? And what are the acquisition and operating costs? So what pricing concessions can I make? What am I going to have to spend to get this business, and what am I going to have to spend to service it? And that limits or enhances your flexibility. Okay, so now we're gonna move to Mr. Mays, and we're going to talk about what you guys reviewed earlier today.
Okay, guys,
Okay.
This case was not an easy case. It may look like it's easy. But there's a lot going on here. So first, before we do anything, we need to decide, kind of understand, again, getting back to knowing your customer, understanding what's happening within the business, et cetera, et cetera. So in this case, what are some of the business issues that you saw? And then we'll just throw them out, and then Barry has the flip charts. We kind of surveyed everybody beforehand and put them up on the flip charts. But what did you come up with when you did this? Okay. Cash situation is deteriorating. If you remember, in fact, the balance sheet, if you look on I've got a projected balance sheet going into 98, but if you look at your handout there, I think the figures were down to around 10 or 11,000 bucks, 15,000 bucks. And over the prior 2 years, it's dwindled down considerably. Okay. And I believe somewhere in the case, the principal said he wanted to have a minimum cash level of what? Do you remember? No, that was how much he was requesting on the line of credit. Does anybody remember? He said he felt comfortable with a cash balance of a certain figure. I think it was 60,000. It was kind of a minimum level of cash that he wanted to have. Okay. So, you know, if you're running this size of a business and you got $15,000 in cash and you got another business issue, and I'll let you talk about this one, but there's some people knocking on his door, isn't there? Okay, so that's a business issue. So exactly what is it? Rick? Go ahead. Okay, so he's leaning on his vendors. His suppliers are starting to get a little nervous about the fact that he's taken 76 days to pay. Okay, what was the industry norm? Do you remember from the case? Okay, 45 to 60 days. So if you have a customer and everybody's paying you in 45 to 60 days, and one of your customers is paying you in 76, it's costing you money basically to sit and wait for that money. I mean, it's costing you. Okay, so if you're the vendor is going to want to try and get Maze to try and accelerate the payment and get it down somewhere within reason. And we've told you that within reason is roughly 45 to 60 days. Okay, so one of the issues is the vendors are knocking on the door, and what is Mr. Maze afraid of happening? I heard it back here. Exactly. Okay, so he may lose some exclusive distribution rights to their products. Okay, if you're a distributor and of I don't care what product, that's going to put a scare into you. Okay, so that's a business issue. What else? Okay, historically has not taken advantage of the trade discounts. Okay, what are the selling terms that most of his vendors, or 60% I believe of his vendors, are offering him? Okay, 2% net 30. Okay, so the inability to take those discounts is going to cost him some money. Okay, so it reduces his cost of goods sold if he can take the discounts. I think for the last 3 years it's dwindled down. I think it was 24,000, 21, so 18,000 last year is what he took advantage of discounts. Okay, what other business issues? What is Maze aspiring to? $50 million a year company, supposedly. That's what the aspirations are. What else? Okay, there's a specific niche that he sells into that's, okay, he sells to department stores, sporting goods stores. Someone said mom and pop, right? Okay, and what did we tell you about the mom and pop accounts? Okay, they're slow payers, basically. They're also what? A little higher profit margin, a little higher gross margin on those accounts. Okay, so Maze may be at a stage of his business where he needs to make some decisions. Okay, maybe about what types of accounts he wants to sell into or not sell into, correct? Okay, he also has some decisions about how to get the vendors off his back, right? Good. Okay, what are the, whoops, what do I need to hit?
Yep. Just hit the,
Okay, so what's basically what we have on our balance sheet? Does everybody have you should have it handy. Okay, go to the balance sheet as it stands for 97. Okay, and if you'll see, as Lynn was saying, you finance assets one of two ways, right? You finance it with debt, or you finance it with equity, correct? Okay, so here you have a business. What have sales done over the last 3 years on the next page? They've grown. Not only have they grown, but the growth rate's been pretty outstanding. Okay, very impressive growth. Okay, so that's why one of the things where some of these rules of thumb that we talked about, where they don't work, is when you have somebody that's just growing like crazy. So if you said 10% of sales and 10% of 7 million, that's $700,000. That might be close, but if he's projecting in 98 he's going to be at 9.6, might need more. Okay, what if you talked to this customer 2 years ago and their sales were at 5.4 million, and at the time you gave the Maze account a $500,000 line of credit? Well, how fast would he have outgrown it? Pretty quick. Okay, so we've also told you something about expected growth in the future with this particular case. And what is that? Okay, so we said that we're expecting that 98 projections will come to fruition, and that beginning in 99 things are going to slow considerably, right? Okay, economic, for various reasons we expect growth to really be slow. Okay, that's real important in this case. Okay, all right. So the financing need, if you look at this balance sheet right here, how's he financing growth right now?